Hi everyone! Today, let me discuss with you this Chapter 7 with the title of Interest Rates and Bond Valuation. To start with, let me first introduce the objectives of this course. Be able to define important bond features and types of bonds, explain bond values and yields and why they fluctuate, describe bond ratings and what they mean, outline the impact of inflation on interest rates, and lastly, illustrate the term structure of interest rates and the determinants of bond yield. To formally start, let me first define what is a bond. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. These are simply issuing or selling debt securities to the public on a long-term basis. The issuer is obliged to pay interest or coupon every period and repay the principal at maturity, and it has a maturity of 10 to 30 years. Here are some key terms associated with bonds that we will often encounter in the duration of our discussion. First is face value. Face value is the principal amount of a bond that is repaid at the end of the term, also called as par value. Next is coupon. Coupon is the stated interest payment made on a bond. Coupon rate is the annual coupon divided by the face value of a bond. Next is maturity, which is the specified date on which the principal amount of the bond is paid. And lastly, yield to maturity or YTM. It is the rate required in the market on a bond. As we mentioned earlier, the bond is normally an interest-only loan, meaning to say the borrower will pay the interest every period, but none of the principal will be repaid until the end of the loan. For example, Stark Industries wants to borrow 1,000 for 30 years with an interest of 12%. Stark will pay 12% of 1,000, which is equivalent to 120 interest every year for 30 years. And at the end of 30 years, Stark will repay the 1,000 face value of a bond. As time passes, interest rates change in the marketplace. However, the cash flow from bond stays the same. Bond value and interest rate have an inverse relationship. They always move in opposite direction. When interest rate rise, a bond's value, like any other present value, will decline. Similarly, when interest rate falls, the bond value rises. And to determine the value of a bond, we need to know the time to maturity, face value, the coupon, and the market interest rate or yield. Most bonds pay coupon semi-annually, which means bondholders receive 2 payments per year or every 6 months. For example, if a bond has 1,000 face value with a coupon rate of 10%, the coupon will be divided into 2, meaning 50 coupon twice a year for the next 10 years. Or can be calculated by face value times coupon rate and divide by 2. To better understand, let us try a sample problem. Calculate the semi-annual coupon for 2.75%. Bond with a face value of 75,000 that matured after 10 years. To determine the semi-annual coupon, multiply 75,000 to 2.75% and then divide by 2. And the answer is 1,031.25. This is the amount of coupon that will be paid every 6 months for 10 years. The risk that arise for bond owners from fluctuating interest rates is called interest rate risk. Interest rate risk refers to the possibility of investment losses due to a change in interest rates. It can affect many investments, most especially the value of a bonds and other fixed income securities. Therefore, bondholders carefully monitor interest rates and make decisions based on how interest rates are perceived to change over time. Looking at a bond, keep in mind that the longer the time to maturity, the greater the interest rate risk, and the lower the coupon rate, the greater the interest rate risk. We already know the bond's price, coupon rate, and maturity date, but not its yield to maturity. So what is yield to maturity? Yield to maturity is a total rate of return of a bond, assume that the investor or bondholder holds the bond until its maturity date. It also refers to as yield or the market interest rate. Furthermore, to find the value of a bond, we can use these two formula, where C is the coupon paid each period, R is the rate, T is the number of period, and F as the bond face value. How to find the yield to maturity? To determine the yield to maturity, we have an example problem. Using the given bond value, coupon, time to maturity, and face value, it is possible to find the rate or yield simply by using the trial and error method. The bond has a face value of 1,000, 80 coupons for 6 years, and is sold at a discounted price. And since the value of a bond drops to 955 for 4.14, the rate will increase. Let's use the first given formula. Try to use different discount rate until the calculated bond value equals the given bond value. So from 8%, let's use 9%. And the total that will be appear when we use the rate of 9% will be equal to the given bond value of 955.14. Securities issued by corporation may be classified as equity securities and debt securities. A debt is a result of borrowing money. When corporations borrow, they promise to pay interest payments and repay the original amount they borrow. They are called debtor or borrower, whereas the person or firm making the loan is the creditor or lender. The main difference between the two is that the latter represent an ownership interest while debt is not. Second, the corporation's payment interest on debt is considered as a cost of doing business and is fully tax deductible, while dividends paid to shareholders are not. And lastly, unpaid debt is a liability of a firm, and if not paid, the creditor can legally claim the asset of the firm. All long-term debt securities are promises made by the issuing firm to pay principal when due and to make timely interest payments on the unpaid balance. The maturity of a long-term debt is the length of time until the debt comes due. Debt securities can be a short-term or long-term. Short-term have a maturity of 1 year or less, which is often referred to as unfunded funds. Debt securities are typically called notes, debenture, or bonds. Notes is an unsecured debt with an original maturity of 10 years or less, while debenture and bonds have longer term. There are two forms of long-term debts. These are public issue and privately placed. The difference between the two is that the latter is directly placed with the lender and is not offered to the public. Next is indenture. Indenture is the written agreement between two or more parties. This is often an agreement between issuing firm and the bond trustees or bank representing the bondholders. It is sometimes referred to as the deed of trust. This legal document provides the detailed loan terms, including the basic terms of a bond, which is the amount of time between the issuance of the bond and its maturation. Next is the total amount of bonds issued, or the principal. A description of property used as security. The repayment arrangement, the call provision, and the detail of the protective covenants, which is going to discuss later. There are two forms of bond issue, the registered form and bearer form. Usually, the corporate bonds is in registered forms, in which the registrar of the company records the ownership of each bond and the payment is made directly to the owner of record. Oppositely, the bearer form do not record the owner's name and the payment is made to the one who holds the bond. There are two disadvantages of bearer bonds. The bearer bonds are difficult to recover if they are lost or stolen, and the company does not know who owns the bonds. Bearer bonds were once dominant type, but they are now much less common than registered bonds. Debt securities are classified according to the collateral and mortgage used to protect the bondholder. The collateral are securities like bonds and stocks, that are pledged as security for the payment of debt. On the other hand, mortgage security are secured by mortgage on real property of the borrower. The property involved are usually real estate, like land and building. Mortgage trust indenture or trust deed is the contractual agreement used to secure the debt of the borrower. Seniority refers to the order of repayment in the event of sale or bankruptcy of the issuer. And to indicate the seniority, the debts are labeled as senior or junior. Example, when comparing unsecured debts to secured debts has seniority. Subordinated debt, also known as subordinated debenture, is an unsecured debt, so their claims are honored only after the claims of secured debts has been satisfied. Bonds can be repaid at maturity, at which time the bondholder will receive the stated or face value of the bond. It may be repaid in part or entirely before maturity. An early repayment often handled through a sinking fund. Sinking fund is an account managed by the bond trustee for early bond redemption. Sinking funds are used to make debt repayment easier and to ensure that a default can happen because there is a sufficient amount of money available to pay debt. Call provision is an agreement that gives the bond issuer the rights to repurchase part or all of the bond issued at stated price over a specific period. Generally, the call price is above the bond's stated value or par value, and the difference between the call price and bond's par value are called call premium. Call premium is the amount by which the call price exceeds the par value of a bond. Deferred call provision. A call provision are often not operative during the first part of the bond's life. It prohibits the company from calling a bond before a certain date. And during this period of prohibition, the bond is said to be call protected. Some different types of bonds. Government bonds. It is a debt securities issued by government to support government spending and obligations. Treasury notes and treasury bonds or T-bonds are both government long-term debt securities with the original maturities ranging from 2 to 30 years. Municipal notes and municipal bonds or munis are short-term debt securities issued by state or local government. Zero coupon bond, a debt securities that does not pay interest. Investors buy zero coupon bond at a price that is much lower than its stated price, but the amount they will receive at maturity is the stated amount. For example, if an investor wants to buy a bond with a face value of 10K with a maturity of 10 years, instead of 10K, he can pay at a discounted price of 8K and still get 10K after 10 years. Floating rate bonds. It is a debt securities whose interest rate or coupon payments to investors are adjusted periodically. For example, if today's rate is 3%, next year it may rise to 5% and may also fall to 2%. There are also other types of bonds like catastrophe bond or CAT bonds. CAT bonds is an insurance securitization. It is a bond that pays the issuer when an incident such as an earthquake or tornado occurs. Bond with warrant. Warrant give investors the right to acquire shares of stock of the issuing corporation at a fixed price. It is often issued at a very low coupon rate. Convertible bonds. These give investors the right to exchange their bond into ordinary shares within a specified period of time. Income bonds. It is similar to convertible bonds, except that coupon payments depend on company income. Put bonds. It allows the bondholder to force the issuer to redeem or buy back the bond at a stated price. And the most recent exotic bond, COCO bond and NONO bond. COCO bond is short for contingent convertible, and these are securities that will absorb losses in accordance with their contractual terms, while NONO bonds is similar to COCO bonds, but NONO bonds is zero coupon bonds. Next is bid price. This is the highest price a person is willing to pay. Ask price is the minimum price a seller is willing to take, and the difference between the bid price and ask price is called bid-ask spread. It is the broker's profit. Clean price is the quoted price where accrued interest is deducted, while dirty price is the price of a bond including the accrued interest, which is also known as full or invoice price. Stock market and bond market. The stock market is a place where investors can trade equity securities, such as shares, that are being offered by companies and businesses, while bond market buy and sell debt securities. Stocks gives investors a partial ownership of a bond, while bonds is a form of debt that a company issues. The biggest difference between them is how they generate profit. Stock appreciate in value and will be sold later on the stock market, while bonds pay interest over time. Next is the inflation and interest rates. Inflation refers to the overall general increase in the price of goods and services, or the increase of cost of living. Inflation can occur when prices rise due to increase in production costs, such as raw materials and wages, and when the demand for goods or services exceed the production capacity. Interest rate. It is the percentage of principal charged by the lender. The lower the interest rate, the more people are willing to borrow to make bigger purchases. This also gives them more money to spend. Let's compare real rate to nominal rate. To differentiate these two in a simpler way, real rate is the rate that have been adjusted for inflation, reflecting the real cost of funds to the borrower and the real yield to the lender or investor. For example, a bank loans a person $200,000 to purchase a house at a rate of 3% as a nominal interest rate. Assume that the inflation rate is 2%. The real interest rate paid by a borrower is 1%. The real interest rate that the bank received is 1%. That means the bank purchasing power will only increase by 1%. In contrast to the real rate, nominal rate is the interest rate that have not been adjusted for inflation, or simply the stated interest rate of a loan. For example, if you borrow $100,000 with 8% interest, expect that you will only pay 8%, no need to adjust for inflation. The Fisher effect. It is an economic theory created by economist Irving Fisher that describes the relationship between real and nominal return and inflation rates. It can be written as 1 plus nominal rate is equal to 1 plus real rate multiplied to 1 plus inflation rate. The Fisher effect states that the real interest rate equals the nominal interest rate minus the expected inflation rate. Therefore, real interest rate fall as inflation increase, unless nominal rate increase at the same rate as inflation. For example, if inventors require a 10% real rate of return and the inflation rate is 8%, what is the exact nominal rate? To determine the nominal rate, the formula will be 1 plus real rate or 10% multiplied to 1 plus inflation rate or 8%, and then after ma-compute, the answer will be 1.18 or 18.80%, which is close to 19%. For us to know the effect of inflation on present value calculation, analyze the given sample. Suppose you want to withdraw money each year for the next 3 years, and you want each withdrawal to have $25,000 worth of purchasing power. If the inflation rate is 4% per year, then the withdrawals will simply have to increase by 4% each year to compensate. The withdrawals each year will be the following. Now, what is the present value of this cash flow if the approximate nominal discount rate is 10%? To determine the present value, we will divide the yearly withdrawals by 1.10%, then add them all so we can get the present value of $67,111.65. The next thing I will discuss is the determinants of bond yields. The relationship between short and long-term interest rate is known as term structure of interest rate. To be more precise, the term structure of interest rates tell us what nominal interest rates are on default-free, pure discount bonds of all maturity, and the pure time value of money for different length time. When long-term rates are higher than short-term rates, we say that the term structure is upward sloping. When short-term rates are higher, it is downward sloping. The most common shape of the term structure, particularly in modern times, is upward sloping. So what determines the shape of the term structure? There are three basic components. The first two are the one we discussed in our previous section, the real rate of interest and the rate of inflation. Real rate of interest. It is the basic component underlying every interest rate, regardless of the time to maturity. When the real rate is high, all interest rates will tend to be higher, and vice versa. Thus, the real rate doesn't really determine the shape of the term structure. Instead, it's mostly influences the overall level of interest rates. Next is the future inflation, which has strong influence on the shape of the term structure. If investors believe the rate of inflation will be higher in the future, then long-term nominal interest rates will tend to be higher than short-term rates. Thus, an upward sloping term structure will reflect anticipated increases in inflation. Lastly, the component of the term structure has to do with the interest rate risk. As we discussed earlier, longer-term bonds have much greater risk of loss than the short-term bonds. The longer is the term to maturity, the greater is the interest rate risk. So, the interest rate risk premium increases with maturity. Treasury yield curve. It is the plot of the yield on treasury notes and bonds related to maturity. The shape of the yield curve reflects the term structure of interest rate. They are almost the same, but the only difference is that the latter is based on pure discount bonds, while the yield curve is based on coupon bond yield. Treasury notes and bonds have three important features. They are default-free, taxable, and highly liquid. There are also additional factors that need to be ascertained when looking at bonds issued by corporations or municipalities. The first thing is the credit risk. That is the possibility of default. Investors demand for higher yields as compensation for this risk, and this extra compensation is called default risk premium. Remember that low-rated bonds have higher yields. Liquidity premium. It is a portion of nominal interest rate or bond yield that represents compensation for lack of liquidity. Liquidity means the ease with which we can convert an investment into a cash. Investors prefer liquid asset over illiquid. Conclusion: if we combine all of the things we have discussed regarding bond yields, we find that bond yields represent the combined effect of no fewer than 6 things. The first is real rate of interest. On top of real rate are 5 premiums representing compensation for expected future inflation, interest rate risk, default risk, taxability, and lack of liquidity. As a result, determining the appropriate yield on a bond requires careful analysis of each of these effects. That's all. Thank you.